Alright, welcome back. This is part 4 of chapter 4. Okay, in the last clip we were looking at the financial planning as illustrated in this diagram. And I was saying that this is the internal funding. Okay, retained earnings will form the internal funding. This is the external funding. This comes partly from the financial policy. Okay, this includes new debt, okay, and also new shares. Issued new shares will provide funds for the company. This is called external funding, and this will be spontaneous funding. This is from accounts payable or other current liabilities. Not including notes payable. Notes payable will come over here. This is external debt. Okay, so this will be spontaneous liability or spontaneous funding. This will be internal funding, and this will be external funding. And all these three, okay, must constitute and to the change in liabilities and equity. And these changes in liability and equity must be equal to the change in assets. Okay, so this is the overall view of the financial planning process. Okay, so this balance between these two, the equality between this change in assets and change in liability and equity must hold always. Is that okay? So this is the basis of the financial planning process. Alright, now we look at a method that we use. As I mentioned, we have used this before in gourmet coffee, but we'll use it more elaborately in the coming example. This is called percentage of sales approach. Okay, where these items are expected or is assumed to change. Vary here means change directly with sales. Most items. That is why we use percentage of sales. Okay. In a more elaborate example, we can assume that some items don't change. Most items change directly with sales, but some items do not. So in the income statement, if costs vary directly with sales, then the profit margin will be constant. Because if sales go up by 15% and costs also go up by 15%, then the profit margin will remain constant. It won't go up. The profit will go up by 15%, but the profit margin, which is the ratio of profit to sales, okay, this will not change. This will remain constant. Alright, but we find that some cost items, particularly depreciation, which is not a cash flow, and interest expense, these do not vary directly with sales, because the depreciation expense and interest expense has very little to do with sales, even though indirectly it is related. If you need to sell more, the sales is greater, then you need to buy more assets. Because you have more assets, you will have more depreciation. But this depreciation to sales may not be directly relevant, or directly related. Okay, there might be an indirect relationship. And interest similar. Okay, so this interest expense may not be directly related to the sales level. Sales may increase, and this sales increase need to be supported with asset increase. But when this asset increase is also supported by the increase in debt, in terms of the same proportion, then we can say interest expense may also rise. But then this interest expense will depend on many other factors. The amount of loan that you take. Okay, if you take more loans, then you'll have more interest. Sometimes this loan can be replaced with equity. You can use more equity rather than debt. So therefore, interest may not necessarily go up. The other factor is that this interest expense depends on the interest rate, and this interest rate may change in the market over time. Therefore, this interest rate is not fixed. The interest rate may go up, and that has nothing to do with sales. And therefore, these two factors do not change directly with sales, and if that's the case, then the profit margin is not constant. It is easier to forecast when the profit margin is constant, but if these two, particularly these two expenses, when they don't vary directly with sales, then the profit margin will not be constant. Then it's more difficult to forecast or do financial plan. Yeah. All right. Even though we mentioned this here, but in the examples that we see in the book, okay, we assume that depreciation and interest also vary directly with sales. Okay, that makes our life easier. Yeah. But in reality, in more sophisticated models, this need not be the case. Yeah? This may change not directly with sales. Yeah? There may be other assumptions used, which may be more realistic. Yeah? But in this case, in this textbook, okay, even though it's stated here, but in all the examples that we see, okay, and the exercises in the book, we assume that depreciation and interest also varies directly with sales. Okay, which is a very simplifying assumption, but that helps us, that simplifies our job of doing the financial plan. Yeah. Alright, then we come to the third point here. Dividends are a management decision and generally do not vary with sales, and this is clearly what we call incorporated into the financial plan. Yeah. Right, so this is not a problem. Yeah? We have seen that before in case 2. Okay, dividend management decision. You can either predetermine this, you can fix the dividend policy, or you can allow it to be a plug variable, as in case 1. So this is deliberately incorporated. Okay, but here these are not deliberately incorporated. We just assume, by assuming that these vary directly with sales, then we can lump all the costs together. Okay, right. Then we move on to the balance sheet. Yeah, once we finish the income statement, okay, forecasting the income statement, then we move on to the balance sheet. Here, initially we assume that all assets, including fixed assets, vary directly with sales. And then we will relax this assumption. Yeah, we will relax this assumption later. But initially we assume that all assets, okay, vary directly with sales. Okay, then accounts payable will normally vary directly with sales, because we call accounts payable spontaneous liability. Therefore, this is another assumption. Now, notes payable and long-term debt, they don't change directly with sales, because this depends on the management decision, deliberate management decision, on whether to use, what to do with the capital structure. Do they want to maintain or do they want to change the capital structure? Okay, so these two, we assume notes payable, long-term debt. In fact, even equity does not vary directly with sales. It varies, like in the case of dividend. We'll come back to equity a bit later. But these two, it does not change directly with sales. So, how do we treat these two? We go through 2 steps. In the first step, we assume that there is no change in notes payable and long-term debt. Okay. And then in the second step, after determining the shortfall or the excess, okay, in funding, then we come back and revise this, notes payable and long-term debt. But in the first step, we assume that there is no change. When we look at an example, then this will become clearer. Alright, then this equity, change in equity will depend on the change in retained earnings portion of equity. And this will come from the dividend decision from the income statement here. Alright, so this will depend on that, and this equity can also change not only due to retained earnings, but also due to expected issue of new shares. Okay, if the company intends to issue new shares in the future, then this will increase the equity. Alright, so this is the percentage of sales approach. Now, we look at this particular example now. We looked at gourmet coffee in the previous clip, previous example, which was a simplified example. Here we have a more elaborate example, but the income statement is not very elaborate. The only addition you have is this tax. Okay, here this cost is still total compared to gourmet coffee. Okay. The difference here is that in gourmet coffee, the costs also include taxes, but here cost does not include tax. Tax is given separately. But it doesn't really matter here, as you will see later. But this cost also include depreciation. Okay, also includes interest. Alright, so that is more or less the same. in the income statement. But if you look at the balance sheet, you look at this is the pro forma income statement for the next year. Okay, we will come to that later. This is the balance sheet. The pro forma is already done here. We'll come back to this column, these two columns here later. But look at this column here. This is the current level of assets, and this is the current level of liabilities and equity here. So based on this percentage of sales method, we want to forecast both the income statement as well as the balance sheet for the coming year, which is 2019. So how do we do that? So we look at this using this Excel worksheet. Okay, let's drag it here. This is the example of gourmet coffee. So we move on to Tasha Toy Emporium. Alright, so we have this here. Right, Tasha Toy Emporium. We can see it here. Now this is the income statement. Okay, and this is the balance sheet. Okay, until below. Right, you can't see the last line. Let me just bring it up here. Okay, you can see the last line here, total liabilities and equity. So this is the balance sheet. Right, so how do we go about forecasting the financial statement, the pro forma statement for the year 2019, next year, using percentage of sales method. Alright, so here you are told that the sales will increase. The first assumption is, or the given information is, that the sales will increase by 10%. In gourmet coffee it was 15%, but here in Tasha Toy Emporium it's 10%. So sales increased by 10% from 5,000 to 5,500. Again, the formula is the current sales level multiplied by 1 plus the growth rate, the expected growth rate in sales. Therefore, it is 5,500. All the costs will also increase by 10%, including taxes. But here, you can compute EBT, earnings before tax, sales minus costs. Okay, this also increases by 10%. Therefore, EBT will also increase by 10%. And since the tax rate is fixed, 21% of taxable income will be taxed, or tax will be equal to 21% of taxable income. So this is the same here, or you can take this multiplied by 21%. You get 347. 1650 multiplied by 21%, you get 347. Right. Then you compute the profit, which is 1650 minus the tax, you get profit. Alright, and then the next step here, dividend policy is fixed, meaning 40% of net income will be paid out as dividend. Therefore, this is similar to case 2 of gourmet coffee, because case 2 is determined first. It is predetermined, it's not a plug variable. In case 1, dividend policy was the plug variable, but here it is similar to case 2. Dividend policy is not a plug variable. So here we determine the amount of dividend paid out, which is 40% of profit. 40% multiplied by 1304, you get 521. This is rounded to the nearest dollar. Then the addition to retained earnings, or retained earnings for the year, will be this profit minus the dividend. So you get 782. So this concludes the first 3 steps. We can do this because the dividend policy is fixed. Alright, then we come to the balance sheet. Okay, all these cash items, these are all step number 4. All these, not cash items, but all these asset items, all these asset items increase by the same rate as the increase in sales. Therefore, this increases by 10% to 550. That is 500 multiplied by 1 plus 10%. Receivables also increases by 10% to 2,200. Inventory also increases by 10% to 4,400. And then net fixed assets increases by 10% to 5,500. In total assets increases to by 10% to 12650.